Before 1913, America's financial system was a wild frontier, prone to violent swings and devastating panics. Without a central authority, individual banks often failed, triggering domino effects that wiped out savings and crippled businesses. The nation lacked an elastic currency, meaning money supply couldn't expand or contract with economic needs, exacerbating crises. This fragmented structure made the United States an outlier among developed nations, which mostly already had central banks. It was a system built on individual trust, perpetually on the brink of collapse. These financial tremors weren't just abstract economic theories, they were real-world disasters that destroyed livelihoods. Every few years, a panic would sweep the nation, freezing credit, shuttering factories, and throwing countless Americans out of work. The absence of a lender of last resort meant that when banks faced liquidity issues, there was no backstop, no central institution to provide emergency funds. This instability created a perpetual climate of fear and uncertainty for investors and ordinary citizens alike. The breaking point arrived in October 1907. A speculative scheme involving copper stocks unraveled, sparking a panic that rapidly spread through New York City's trust companies. Depositors, fearing for their savings, rushed to withdraw funds. Banks, already operating on thin reserves, began to fail. The crisis threatened to engulf the entire national economy, revealing the severe vulnerabilities of America's decentralized banking system. The nation desperately needed a solution, but knew not where to turn. In the face of this unfolding catastrophe, it wasn't the government that stepped in, but a private citizen, J.P. Morgan. The titan of finance personally orchestrated a bailout, convening leading bankers at his mansion, locking them in until they agreed to pool resources to shore up failing institutions. Morgan's intervention, while effective, underscored a critical flaw. America's financial stability shouldn't rely on the whims or capabilities of one powerful individual. This crisis became the undeniable catalyst for change. Public and political pressure mounted for comprehensive banking reform. President Theodore Roosevelt and his successor, William Howard Taft, both recognized the urgent need for a more stable system. However, the American public harbored a deep-seated suspicion of centralized power, especially financial power. Memories of past conflicts like Andrew Jackson's war on the Second Bank of the United States fueled fears that a central bank would become a tool for Wall Street elites. Any solution would need to navigate this profound mistrust.
In 1908, Congress passed the Aldrich-Vreeland Act, a temporary measure allowing national banks to issue emergency currency. More importantly, it established the National Monetary Commission, tasked with studying financial systems worldwide and proposing a permanent solution. This commission, led by Senator Nelson Aldrich, a powerful Republican from Rhode Island, embarked on an extensive research mission across Europe, examining established central banks in countries like England, France, and Germany. They knew a homegrown solution was vital. The commission's findings confirmed that modern nations needed a centralized mechanism to manage money and credit. But translating European models to the American context was fraught with difficulty. The crucial challenge was designing a system that offered stability without appearing to consolidate excessive power in the hands of a few wealthy bankers or the federal government. The political climate demanded a delicate balance, particularly concerning control over currency issuance and lending. It was a problem that had plagued the nation since its founding. With public sentiment firmly against any plan perceived as a Wall Street creation, the influential figures driving reform knew they couldn't draft legislation in the open. The solution required absolute secrecy. If word leaked that powerful bankers were shaping the nation's financial future behind closed doors, the entire initiative would be doomed before it began. This meant a covert meeting, away from the prying eyes of the press and the suspicious glare of populist politicians. The chosen location for this clandestine gathering was Jekyll Island, Georgia. A remote, exclusive resort owned by a club of America's wealthiest men, it offered the perfect cover of privacy and isolation. It was an improbable setting for the birth of a nation's central bank, far from the bustling financial centers of New York or Washington. This secluded haven would soon host a secret conference that would forever alter the course of American economic history. In November 1910, 7 men, representing the pinnacle of America's financial and political power, converged on Jekyll Island. Among them were Senator Nelson Aldrich, Paul Warburg, an expert on European central banking, Frank Vanderlip, president of National City Bank, Henry Davison, a senior partner at J.P. Morgan & Company, and Benjamin Strong, also closely associated with Morgan interests. These were not just bankers, they were architects of finance, united by a shared conviction that America needed a better system.
To maintain their absolute secrecy, the delegates adopted a flimsy cover story. They pretended to be on a duck hunting trip. They used only first names to address each other and avoided being seen together in public. The elaborate charade was essential. Any hint of their true purpose would have ignited a firestorm of public outrage and derailed their efforts. This commitment to discretion speaks volumes about the perceived political sensitivity of their mission. The journey to Jekyll Island itself was carefully orchestrated. The men traveled separately, often by private railcar, making their way south under the radar. Once on the island, they lived and worked in close quarters for over a week, intensely debating and drafting the blueprint for what would become the Federal Reserve. Far from the scrutiny of the press, they could freely exchange ideas, confront disagreements, and forge the necessary compromises that an open forum might never have allowed. The discussions on Jekyll Island were intense, reflecting the complex challenges facing the nation. They grappled with fundamental questions: how to create a stable currency, how to prevent future panics, what balance to strike between private banking interests and public control. Paul Warburg, with his profound understanding of European central banks, played a crucial role, advocating for a decentralized system that still possessed centralized coordination, often pushing for radical departures from current American practice. Central to their debate was the concept of an elastic currency, a money supply that could expand during economic booms and contract during downturns, unlike the rigid gold-backed system then in place. They envisioned regional reserve banks, not one monolithic institution, to address America's vast geographical and economic diversity. This decentralized approach aimed to assuage fears of a single, powerful money trust dominating the nation's finance from New York. It was a pragmatic concession to political realities. They studied the Bank of England's role as a lender of last resort and Germany's Reichsbank's ability to issue flexible currency. While these European models offered valuable lessons, the American delegates understood that their solution needed to be uniquely suited to the United States political and economic landscape. They sought to blend the efficiency of European systems with America's deeply ingrained distrust of concentrated power, ensuring the new institution would avoid past pitfalls.
After days of intense deliberation, compromises were made. The Aldrich Plan emerged, a proposal for a National Reserve Association, a central body governed by regional districts. It incorporated features like rediscounting commercial paper to provide liquidity and mechanisms to manage the money supply. This plan was a revolutionary step for American finance, designed to prevent future panics and bring stability to the volatile economy. However, its origin would prove to be its greatest vulnerability. Upon its eventual public unveiling, the Aldrich Plan was immediately met with suspicion. The fact that it was drafted by a Republican senator and prominent Wall Street figures, even if behind closed doors, fueled populist accusations that it was merely a vehicle for bankers to further consolidate their power. The plan struggled to gain traction in Congress, becoming entangled in partisan politics and public distrust. Despite its merits, the perception of its origins proved too great an obstacle. The presidential election of 1912 drastically altered the political landscape. Woodrow Wilson, a Democrat and former governor of New Jersey, won the presidency, campaigning on a platform of progressive reform. His victory signaled a shift in power dynamics, creating a new opportunity for financial legislation, but only if it could overcome the lingering public and political opposition to the previous proposals. The stage was set for a different approach. With Wilson in the White House, the focus shifted to new congressional leaders. Representative Carter Glass of Virginia and Senator Robert Owen of Oklahoma took the helm, determined to craft a central banking bill that could pass. They skillfully blended elements of the Aldrich Plan with democratic principles, emphasizing federal oversight and regional autonomy. Their challenge was to create a system robust enough to ensure stability, yet sufficiently decentralized to assuage the public's deep-seated fears of financial concentration. Wilson himself played a crucial role, actively lobbying Congress and making strategic compromises. He insisted on a strong measure of government control, particularly regarding the appointment of the Federal Reserve Board members, to ensure public accountability. His leadership was instrumental in bridging the gap between the progressive wing of his party, who wanted more government control, and the banking community, who desired autonomy. This blend of public and private influence was a critical evolution of the original Jekyll Island concepts.
After much debate and revision, the Federal Reserve Act was finally passed by Congress. On December 23, 1913, just before Christmas, President Woodrow Wilson signed it into law. This historic moment marked the official birth of the Federal Reserve System, America's first permanent central bank. It was a triumph of political will, compromise, and a recognition that the nation's economic future depended on a more stable and regulated financial structure. The Federal Reserve Act established 12 regional Federal Reserve banks, overseen by a Federal Reserve Board in Washington. Its primary goals were clear: to provide the nation with a safer, more flexible, and more stable monetary and financial system. It gave the government control over the money supply, introduced a more elastic currency, and created a robust mechanism to support banks during crises, effectively ending the era of devastating financial panics. The immediate impact was profound. The Fed quickly moved to organize the regional banks and establish its operational procedures. It began to issue Federal Reserve notes, replacing the disparate forms of currency that had complicated commerce. The new system immediately demonstrated its value during World War I, helping to finance the war effort and stabilize the economy amidst unprecedented demands. It represented a monumental step forward for American financial maturity. Over the decades, the Federal Reserve has evolved, adapting its tools and responsibilities through numerous economic challenges, including the Great Depression, World War II, and countless recessions. It has grown into one of the most powerful economic institutions in the world, influencing everything from interest rates to employment levels. Its creation, born from a secret gathering on a secluded island, remains a testament to the nation's capacity for reform in the face of crisis. The story of the Federal Reserve's birth highlights a crucial truth. Even the most fundamental and seemingly permanent institutions often have clandestine, politically charged origins. It reveals how a severe financial crisis, coupled with the foresight and clandestine efforts of key individuals, can force a reluctant nation to embrace radical reform. From a secret island pact, America built the backbone of its modern financial system, proving that stability sometimes requires radical and often hidden beginnings.